So good day. Our topic for today is accounting policy changes in accounting estimate and errors, or IAS number 8. So what are the types of accounting changes? There are three types of accounting changes, and these are change in accounting policies. So what are accounting policies? These are examples of accruals and cash basis. Although nowadays that since the IFRS would only require accrual basis accounting, so cash basis accounting is now considered as accounting errors. Next, change in accounting estimate. Estimates is something to do with the amounts in the life that are based on our professional judgments, like the depreciations, the life of the buildings, and so on and so forth. Next, correction of prior period errors. So usually, this pertain to our retained earnings or incomes, or the expenses treatment. So what is accounting policy? Accounting policy are specific principle and procedure implemented by a company's management team that are used to prepare its financial statement. So like accrual, matching, the recognition principle, these are example of our accounting policy. So let's take a look, for example, the accounting method, and usually accounting method are only two, which is that were accrual and cash basis. Next, we also have accounting measurement system like the FIFO and the LIFO for inventory. We also have procedure for presenting disclosures. But nowadays, the disclosure requirements are also stated in our accounting standards, IFRS or ES. Okay? So accounting policies, measure, and disclosure. So usually, the application of accounting policy should be retrospective, especially if this affect our previous income. Like for example, the statement of our inventory from LIFO to FIFO, it should be retrospective, meaning the previous financial statement should also be restated as the change for this policy. But prospective, if there is no occurrence on the previous financial statement is affected or materially affected. So the disclosure, the company should disclose or provide relevant information as the basis for prospective or retrospective applications. Okay, so when we say retrospective, meaning we restate the financial statement from its previous effect to the current. Prospective, we don't restate our previous financial statement, but only affect our current financial statement and the succeeding financial statement. Unlike retrospective, it goes back. Okay? So we need to disclose the reason why we would adapt the prospective and or retrospective application. Okay, so let's see the example. Before the respective changes, example of this, we have now statement of financial position. We focus only on the inventory. So we have cash, 6 and 4, and then short-term investment, suppose is 1,000. And then inventory. So we have now our inventory. Before it's 12, 13, and 10. But after our retrospective change, we see that the inventory are not anymore 10 and 12. Instead, it's now 12 and 13 because of the change in our measurement of inventory. Okay, it could be FIFO, LIFO, weighted average. Because this affect our ending and our beginning inventory for our financial statements. Next, accounting estimate. Accounting estimate is an adjustment of the carrying amount of an asset or a liability or the amount of the periodic consumption of the asset that results from the assessment of the present status of and expected benefits and obligation associated with assets and liability. So usually, the example of accounting estimate would affect the life of the building, the depreciation expense, because take note that the computation of our depreciation is based on our estimation of life. What else? The fair market value, estimations of fair market value. But nowadays, it's not allowed because we need to hire independent appraisal for the fair market value. Okay? Provisions. Provisions, we also estimate provisions and the warranty because not everybody would avail for the warranties and the promos. So these are what we call the obligations or the contingent also. So example of these are loss for the provision of environmental damages claim. So remember the oil spill before? So we don't know what extent is the damage for that one. So that would be based on accounting estimates for the cleaning up and the restoration of our reef. And then loss on provision of estimated life of the assets. For example, the building. We expect a building 10 years, but because of some events, you realize that the building should now be demonetize its life. Loss on provisions of warranty because we don't know how many people would take the warranties. So, accounting estimate, measurement are usually prospective application. So, it affect only the current and the succeeding financial statements. So, the disclosure, we disclose the nature of any change. Why do we change the provisions or the life? The effect of change on the assets, the liabilities, because for example, assets, life, amounts, liabilities, why do we have the provisions for the warranties, and then the income and expenses for the current period. And if it's practicable for the entity to estimate the effect of change to one or more periods, because take note, it's a prospective on the succeeding period. So let's take a look of our example. Our, our adjustment of carrying amount of an assets or liability, or the amount of periodic consumption of an assets or liability. That result from assessment of present status and expected future benefits or associated with it. So take note, as said in the disclosure, we need to check the carrying amount and the periodic consumptions, the life of the asset. So that we will determine or assess whether this would affect the beginning or the ending. So example, we have a financial period, depreciable asset, the carrying amount is 80,000. The original cost price, purchase beginning 2014, was 100 and a residual value of 10. Depreciation for the year is 9 years life. So what if we had realized that based on 2016, only 5 years is remaining? So we would now 80,000, the carrying amount, the residual value or the scrap value in some book, 10,000. Then we divide it by the life. Okay? So the carrying amount for 2016, it's 80,000 less 16. We now have 16,000. So every year and future period depreciation is now 14,000. So this is an example of our accounting for change in estimates. So accounting error, and also known as prior period errors, are omission and misstatements in the financial statement for one or more prior period arising from a failure to use or misuse of reliable information. So normally this was when the information was available or was not available when the financial statement for this period were authorized to issue or for issuance, or could reasonably be expected to have been obtained and taken into account in the preparation and presentation of the financial statement. However, such error could include effect on mathematical mistake in applying accounting policy, overrides, or misinterpretation of facts or fraud, and usually the extent of which is impracticable to determine either on a specific effect or the cumulative effect of the error. And an entity shall correct all the material prior period error in the first set of financial statement authorized to issue after the discovery of which. Okay, so if the effect would be for this period, and once it was known that the same effect is material, then they have to restate the financial statement on which the discovery has been determined. So they had to restate. Okay? So accounting example of these are error on original entry, duplication, omission, reversal, or principal. Example, fire. You were able to issue the financial statements, but there was been fire on some warehouse that was not determined earlier, so such should restate the financial statements. Okay, or taxes. You have some taxes misstatements. Okay? So measurement, take note that the measurement of this is retrospective. So it should be restate the financial statement from the beginning when the error has been determined. The disclosure, we had to restate the comparative amount for the period presented in which the error occurred. If the error occurred before the earliest period, presented, restate the opening balance of the asset, liabilities, and equity for the earliest period presented. Example, in 2020, after the entity's 2021 financial statement were approved for issue, the entity discovered a long-standing computational error in the calculation of depreciation expense. Take note, this is not an accounting estimate because there is a wrong calculation of depreciation expense, not a different estimation of the life of the expenses, okay? Because it was specifically stated it's a computational error. So, the cumulative effect of the error on the retained earnings. So, how do we do that? So, see, we have, for example, the profit before tax previously stated as 185,000, but now it's 200 and restatement for the prior years as 160. Income for this, so it's 50 previously, now it's 50,000. So, we also have to restate prior year. So, the profit before is 140, now it's 150, and the prior year was 120. So, the retained earnings now would now be 320. Previous statements, whereas previously stated 420 and 100. So, since we correct the error, what's now? So, we have now the 150 and the 320. Hence, for the year ended, the retained earning is now 470 and not 420. And for 2020, we have previous year profit 120. And then the retained earning for the beginning of that year, 200. So, therefore, we have now 380,000, 20,000 for the retained earnings. So, hopefully you like my video and help me reach out more people by hitting the subscribe and the like button below. God bless you and keep safe. Bye!